After studying this module, you shall be able to understand different types of cost and risk involved in international investment. 2. Evaluate the economic and country risk. 3. Know about the techniques to assess country risk. Let's look at the introduction. In times of uncertainty, the risks associated with engaging in international operations have increased substantially. Moreover, such risks have become more difficult to analyze and predict for decision makers in the international financial community. Country risk reflects the ability and willingness of a country to service its foreign financial obligations. Such risk may be prompted by country specific and regional economic, financial, political and composite factors. Country risk is of critical concern in the world today, with almost every economic, financial and political crisis or conflict threatening to exceed their initial borders. In the current state of world affairs, the economic and financial wealth and political power of a country are decisive for its dominant position in the international financial community and political status. All business transactions involve some degree of risk. When business transactions occur across international borders, they carry additional risks not present in domestic transactions. These additional risks, called country risks, typically include risks arising from a variety of national differences in economic structures, policies, socio-political institutions, geography and currencies. Many of the individual events investigated by country risk analysis fall closer to uncertainties than well-defined statistical risks. Let us look at and understand different types of cost and risk involved in international investment. When companies operate at global level, the investment decision for such companies is not as simple as it is in case of a firm operating at domestic level. In this section, we are discussing the different cost or risk involved in international investment. These are: 1. Currency risk. Currency risk is nothing but the way by which the value of overseas investment is affected by the unfavorable changes in the exchange rate. For example, if the currency appreciates, the USA dollar value falls, and if our currency depreciates, then the value rises. A weakening of the USA dollar means it takes more USA dollars to pay for imports, and of course the price of everything else, including overseas holidays, goes up. The USA dollar is less likely to gain against all other currencies at the same time. So if you have any overseas investment in a range of currencies, in a range of countries, the appreciation of US currency against some other currencies can be offset by the depreciation against others. This means having investments in a range of countries minimizes any exchange rate risk, market risk. The overseas share markets will have good times as well as bad times, just like here in the USA. The best way to minimize market risk is to diversify and invest in a range of countries as well as a range of companies within those countries. This ensures that any losses can be offset by gains from other areas. Economic risk. Economic risk comes about where the overseas countries outperform the USA economy, which means the USA investor will potentially miss out on the higher returns overseas. Most Americans are exposed to the local economy and their income is linked to the success of the economy. Liquidity risk. This is another kind of investment that also affect the return on international investment. Money has only a limited value if it is not readily available to you as and when you need it. In financial jargon, the ready availability of money is called liquidity. An investment should not only be safe and profitable but also reasonably liquid. An asset or investment is said to be liquid if it can be converted into cash quickly and with little loss in value. Liquidity risk refers to the possibility of the investor not being able to realize its value when required. This may happen either because the security cannot be sold in the market or prematurely terminated, or because the resultant loss in value may be unrealistically high. Purchasing power risk or inflation risk. Inflation means being broke with a lot of money in your pocket. When prices shoot up, the purchasing power of your money goes down. Some economists consider inflation to be a disguised tax. Given the present rate of inflation, it may sound surprising, but among developing countries, India is often given good marks for effective management of inflation. The average rate of inflation in India has been less than 8% per annum during the last 2 decades. Interest rate risk. In this deregulated era, interest rate fluctuation is a common phenomenon with its consequent impact on investment values and yields. Interest rate risk affects fixed income securities and refers to the risk of a change in the value of your investment as a result of movement in interest rates. Suppose you have invested in a security yielding 8% per annum for 3 years in India, whereas it is 10% per annum for 3 years in British. Due to this, the decision to make investment becomes complicated. It is because in one way there is an opportunity to earn at least 1% interest higher in UK, but at the same time there is always fear to lose such income due to exchange rate risk. Transaction cost risk. Like all other risks, transaction cost risk is also an important one. It has direct impact on the international investment. It may involve flotation cost, taxes, underwriting commission, etc. Political risk. The government has extraordinary powers to affect the economy. It may introduce legislation affecting some industries or companies in which you have invested, or it may introduce legislation granting debt relief to certain sections of society, fixing ceilings of property, etc. International political developments also have an impact on the domestic scene, what with markets becoming globalized. This was amply demonstrated by the aftermath of 9/11 events in the USA and in the countdown to the Iraq war early in 2003. Through increased world trade, India is likely to become much more prone to political events in its trading partner countries. Expropriation risk. There are two types of expropriation, direct and indirect. The government coming in and snatching up every single piece of private property under the banner of agrarian reform is pretty close to direct expropriation as you can get. On the other hand, the government increasing property taxes eightfold to the point where half of the country can no longer afford to maintain ownership of their home is an indirect form of expropriation that happens all the time. Let's evaluate the economic and country risk. Country risk is a broader concept than political risk. It involves the possibility of losses due to country specific economic, political or social events or because of company specific dimensions. On account of this, it is said that all political risks are country risk, but all country risks are not political risk. Country risks are of normally two types, macro risks and micro risks. Macro risks are those which affect all the multinational firms, whereas micro risks are firm specific. Let's look at macro risk in detail. This kind of risk arises because of government political decision regarding the investment or disinvestment policy for a firm. Forced investment may take place due to the one, in the opinion of government, it may make better use of the assets. 2. Takeover may enhance the political image of the government. 3. When the government wants to enhance the controlling power over these assets for strategic or development reasons. The best example of forced disinvestment is a takeover of oil exploration and oil producing industry. Such industry initially was started by the private entrepreneurs, which with the help of political philosophy later on was nationalized. Tight regulation. Normally, government always wants to reduce profitability of MNCs with the tight regulated norms. Such regulations may relate to the tax laws, ownership, management and reinvestment, etc. Interface with operations. Interface with operations refer to any government activity that makes it difficult for a company to run its business efficiently and effectively. Such risk is the outcome of government engagement in the encouragement of unionization, expression of negative comments about foreigners, etc. The governments generally engage in these kinds of activities when they believe that a foreign company's operation could be detrimental to the local development. Social dissensions. Social dissensions or strife may arise in any country by virtue of ethnic, racial, religious or natural calamities such as drought, etc. All these factors may cause economic distortion. Micro risks. Such risks are firm specific and affect almost every firm differently. These are explained as corruption. Corruption can adversely affect an MNC's international investment decision because it may increase the cost of conducting business or reduce revenue. Various forms of corruption can occur at the firm level. For example, an MNC may lose revenue because a government contract is awarded to a local firm that paid off a government official. Goal conflicts and economic policies. It is quite possible that conflicts between objective of host country government and multinational firms may exist. Such differences may be with the following reasons. Monetary policies. Monetary policy is a mean to control the cost and availability of domestic credit and long-term capital as a means of achieving the national economic priorities. Such national policy is largely affected by the conversion of larger amounts of foreign currency into domestic currency for investment or speculative objectives. Fiscal policies. Sometimes it has been seen that government normally commits some tax concessions and subsidies to attract FDI. Therefore, for a MNC, there is always a question to think about the rationale for such favor done by the host country. Trade policies. The significance of nationalized economic policies was to protect the interest of domestic industry through tariff and non-tariff barriers. However, it is difficult to identify because these barriers may be in the name of health, safety, quality, social clauses and security. Balance of payment problems. Through repatriation by MNCs, there is always a high pressure on the much needed foreign exchange resources. The outflow is in the form of management fees, royalty, etc. And this puts pressure on the balance of payment. On account of this, balance of payment position of a country may become worse. Therefore, the government has to regulate the activities of MNC. Economic development policies. It is quite possible that the economic development policy and policies for the development of a MNC's business in a country may vary to each other. Due to such mismatch in the objective, the government has to regulate the activities of MNC. Let us look at the techniques to assess country risk. Once a firm identifies all the macroeconomic and microeconomic factors that deserve consideration in the country risk assessment, there is need for evaluating these factors and determining a country risk rating. Techniques to assess country risk. 1. Checklist approach. According to this, a judgment is made on the basis of all the political and financial factors that lead to a firm's assessment of country risk. As we know, substantial amount of information about countries is available on the internet. With the help of such information, ratings that are assigned to a list of various political and financial factors, the degree of country risk is measured. Delphi technique. As per this technique, country risk is analyzed with the help of collected independent opinion without group discussion. The MNC can average these country risk scores and assess the degree of disassociation by analyzing deviation of the opinions. Econometric modeling. After analyzing both financial and political variables over a period of time, econometric models for quantitative analysis can attempt to identify the characteristic that influence the level of country risk. For example, regression analysis may be used to assess risk since it can measure the sensitivity of one variable to the other variables. Investigating visits. The purpose of such visit is to assess the degree of overall risk that prevails in the country. It is done by traveling to a country and meeting with government officials, business executives, etc. Such meeting can help to clarify the amount of uncertainty that exists for a country. Measuring country risk. An overall country risk rating using a checklist can be developed from separate ratings for political and financial risk. First, the political factors are assigned values within some arbitrary chosen range, such as values from 1 to 7, where 7 is the best value and lowest risk. Next, these political factors are assigned weights representing degree of importance, which should add up to 100%. The assigned value of the factors times their respective weights can be summed to devise a political risk rating. The process is repeated for computing the financial risk rating. Like political risk, the financial factors are assigned values within some arbitrary chosen range, such as values from 1 to 7, where 7 is the best value with the lowest risk. Next, these financial factors are assigned weights representing degree of importance, which should add up to 100%. The assigned values of the factors times their respective weights can be summed to derive a financial risk rating. By adding both the political risk rating and financial risk rating, overall country risk is computed. Let's summarize. All business transactions involve some degree of risk. When business transactions occur across international borders, they carry additional risks not present in domestic transactions. In times of uncertainty, the risks associated with engaging in international operations have increased substantially. Moreover, such risks have become more difficult to analyze and predict for decision makers in international financial community. Country risk reflects the ability and willingness of a country to service its foreign financial obligations. Such risks may be prompted by country-specific and regional economic, financial, political and composite factors. Country risk reflects the ability and willingness of a country to service its foreign financial obligations. Such risks may be prompted by country-specific and regional economic, financial, political and composite factors. Currency risk is nothing but the way by which the value of overseas investment is affected by the unfavorable change in the exchange rate. For example, if the currency appreciates, the USA dollar value falls, and if our currency depreciates, then the value rises. The overseas share markets will have good times as well as bad times, just like here in the USA. The best way to minimize market risk is to diversify and invest in a range of countries as well as a range of companies within those countries. Economic risk comes about where the overseas countries outperform the USA economy, which means the USA investor will potentially miss out on the higher returns overseas. Country risk is a broader concept than political risk. It involves the possibility of losses due to country-specific economic, political or social events or because of company-specific dimensions. It is often said that all political risks are country risks, but all country risks are not political risks. Country risks are of normally two types, macro risk and micro risk. Micro risks, macro risks are those which affect all the multinational firms, whereas micro risks are firm specific. Once a firm identifies all the macroeconomic and microeconomic factors that deserve consideration in the country risk assessment, there is need for evaluating these factors and determining a country risk rating. Techniques to assess country risk include checklist approach, Delphi technique, econometric analysis, investigating visits, etc.